everyone. My guest today is Rajiv Lapasia. He is the founder and portfolio manager at RBL Investments, which was started in 2018. Before that, he was at BlackRock and he was at Caxton. And he's a former doctor, now a portfolio manager, and he's here to talk with us today about his investing journey, how he got into investing, and what he's discovered along the way. Rajiv, thanks for being here.
Thanks for having me, Scott.
So you're a medical doctor, and did you get your medical degree just 3 years after you graduated college?
It was actually 4 years, but I was in one of these BSMD programs, where you get your Bachelor of Science and medical degree as kind of a combined thing. Back then, they had a bunch of these 6-year programs all over the country, and now some of these have transitioned to 7-year and traditional 8-year programs. So you do your undergraduate in 2 years instead of 4, in my case, and then you do the traditional 4 years of medical school. And there was one of these programs in my own backyard in Northeast Ohio, which is where I went to undergrad and medical school.
That's intense. That's really intense. That's impressive.
It's interesting. I mean, obviously, you're going through school. You don't have summer vacations and all that kind of stuff in undergrad, but my memories are all good. You're working hard with a bunch of your friends and colleagues, and you're all in it together. But it's a lot of fun as well.
What got you into medicine? Was that something you always wanted to get into?
Well, I was born and raised in Northeast Ohio, very middle class upbringing, and the people that you admire in those days, many years ago in the Midwest, were the local doctors. We had a lot of family friends that were various types of physicians, and inevitably they were the most respected and people in society, and also they seemed to generally enjoy what they were doing, and so that's kind of what set the spark off in terms of the thought process. And spent most of my childhood in Ohio, and then my parents, who are first generation immigrants from India, decided that my younger sister and I should spend a few years in India, and so we spent a few years of schooling there, and that very intense experience, but also got even further exposed to the medical profession, through some family contacts and that sort of thing. So my father was an engineer, and his advice was always, do what you love. Every time I'd ask him, what I should do. And so I said, this seems pretty interesting. And so, that was kind of it's a pretty simple, straightforward decision-making process.
That's interesting that he encouraged you to do what you love. I would imagine someone who'd immigrated here would be giving you a ton of pressure to just aim as high as possible. And yet he didn't do that.
Yeah, I mean,
that's nice.
My dad's always been, very low, because I'd ask him, I remember asking him weekly or monthly, when he'd come home from work, about what he does, and he'd tell me everything, take me to the office. He was a civil engineer at the same firm for, over 40 years. So I got a lot of exposure to that. But yeah, I mean, again, I guess some of it is based on, your parents and, what they expose you to. And that was his the big thing I remember from all our conversations, when I was young. And my mom, she always pushed me to read a lot. And I used to push back against that a lot. It's funny that took a much longer time. That lesson took a much longer time to take. Maybe 30 years later, now I read all the time. But it was a combination of, mom and dad kind of. You just remember those, persistent lessons. They pound into you when you're young.
Yeah, is practicing medicine just awful? I know so many doctors that are so unhappy, and it's just they're plugged into this big. It's like they're plugged into the Death Star, and they're dealing with these insurance companies who make their lives hell, and they're running an office and just doing all this stuff they hate. And I'd say half the doctors I know just find it a lot more difficult than they thought it would be.
I'm probably not the best person to kind of talk about practicing medicine because I never practiced. I left after my second year of residency in what was a 7 year residency training program in neurosurgery. So, but I do talk to a lot of friends who are kind of mid career, my age currently, and I would say it's interesting. The majority of them, or I'd say, at least half of them enjoy what they're doing and most of the aspects of what they do, and I don't think they would do anything else, including my younger sister, who's a excellent clinician. Um, there are some. On the other half, I think, in some shape, way, or form, have gotten burned out, either physically. If you're, I have a friend who's an interventional radiologist, and he's, wears this lead on his, chest all day, and it's physically very demanding. Some specialties are very demanding physically, and then depending on what kind of practice environment you're in, it can, also wear at you. As we know, most physicians are now employees. They're not, independent practitioners or entrepreneurs, perhaps as they may have been, 20, 30 years ago. So I'd say, again, my experience in talking to a lot of colleagues, and I'm also on the board at my medical school. So I talked to a bunch beyond the people I went to medical school with. And I'd say it's half and half. There's definitely a tremendous amount of, burnout related to, um, that grind, but also some of the administrative stuff that, record keeping, bookkeeping, that physicians have to deal with. But there are also some that are very entrepreneurial. I have a friend who's a vascular surgeon in Ohio who's who's on his own, and he's building a big new surgery center, and he's going to have other doctors working with him, working for him. And so, like anything, I think there's a distribution, but there's no doubt that certain specialties, and you forget about specialties, primary care doctors who are very, very important to the system. I'm not sure they're treated as well as they should.
Mm-hmm.
They should be, yeah.
And then you switched over to investing. And actually, I don't know if you know this. I'm a novelist. I've had my fifth book's coming out in a couple of months. But I actually at one point was developing a story about two brothers who are raising their kid sister, and one of the brothers is kind of this emotionally shut down guy. He's the older one, and the grim, serious one. And I was going to make him a doctor who worked with pediatric cancer patients, and he basically left
Mhm.
the practice in order to go to Wall Street and run this large hedge fund. And people would say, why did you leave medicine? Why did you leave that? Was it just too much of a grind? Was the emotional toll too high? And he'd be like, no, I just didn't find it very intellectually stimulating. And people would just be appalled that he, that he had this side. But I, it always, I always, every time I meet someone, actually, you're the second person I've ever met who's a doctor who went into investing. I always think of that, and it always just secretly makes me laugh. But what got the hook in your mouth with
Well,
investing?
well, the main thing is I was training to be a surgeon, a neurosurgeon, and to be a good surgeon, you only realize this when you're in residency after medical school and you're in the hospital every day and you actually get a feel for what it's like to be doing, your specialty for a living. And in most surgical disciplines or most procedure based disciplines, it's a lot of technical repetition, as you could imagine.
Mm-hmm.
And I would say 80% of what you do might be very common procedures. And if you really enjoy the process of perfecting that technical repetition, of course, there's some variations, there's some complications, there's some very interesting cases, no doubt about it. But in general, if you enjoy that process of technical repetition, you're going to be really good at what you do because you're going to be doing it. Your training is anywhere from 5 to 7 years, and you're gonna get to where you need to be, whether you're a general surgeon or any other subspecialist. That's not an issue. And it was a revelation that took a while for me. It was probably a 2 year process, gradual process, just to realize that, hey, when I look at my attending physicians that were training me, who I have a tremendous amount of respect for and still keep in touch with, I didn't see myself doing what they were doing 10 years hence, 20 years hence. And so I would say it was a very gradual realization, but it became pretty obvious. And then the question became, okay, I may not want to do this the rest of my life. Does it make sense to at least complete the training? And then, you could always do something unconventional, go to business school or, what have you, after that. In my case, neurosurgery was a 7-year training program. So, I kind of came to this realization around, middle of year two, end of year two. And, I always have believed in doing, going back to my dad again, focus on what you enjoy. And it's okay if you course correct at some point. Luckily, you can do that in this country, from a career standpoint, especially when you're younger.
Mm-hmm.
And so it was that first and foremost, I would say, was a realization that I didn't see myself practicing medicine, um, long term. And so I said, okay, well, rather than wait another 5 years to complete training for the sake of completing training, let's explore other career paths. So I started, for example, I started considering a bunch of things, but I talked to a medical device company in St. Louis to understand if going to the corporate side of healthcare would make sense. I had a couple of friends on Wall Street within the healthcare vertical doing equity research, so they gave me access to Reuters first call. So I was able to start reading some equity research reports just to understand what that whole business was all about
And
from an
did you ever
investment
take in a
standpoint.
finance class or anything like that?
I took some economics course in undergraduate, but as an undergraduate, and I used to watch Wall Street Week with Louis Rukeyser way back in the day with my dad. But I'm not. I definitely wasn't. One of these people who had some intense like side interest in investing. When I was young. And so I tried to approach this process of looking at other career paths pretty open mindedly. And the more I learned about equity research, again, primarily through reading research reports and then cold calling actually sell side analysts primarily, and just seeing if they would talk to me. Again, this is all in the healthcare vertical, so at least I had the benefit of being somewhat focused. It seemed interesting, and so I took a week off. When I had vacation, second year of residency, and visited some people in New York, and again, this was a gradual process, several month process. And, the more I learned about finance and investing in particular, it seemed like something I'd be interested in. But of course, you don't know. I hadn't gone to, undergraduate business school or anything of that nature. But, at some point, I think the thing that really, kind of going back to really doing what you enjoy, I was pretty
Mm-hmm.
sure I wasn't going to enjoy practicing medicine. And so I think that made it easy to take the step of saying, okay, it's time for me to leave and then dedicate myself to a full time job search, primarily um, in equity research. But as I mentioned, I was considering other things, outside of the investment world. So I left my residency, almost when I was through the second year, moved in with a family member, an uncle in North Jersey, and used to commute to New York every day and just network. And through that process, I got a job a couple months later at a small hedge fund as a healthcare analyst. Not that I knew how to analyze anything at that point, but that was kind of it was that serendipitous of a process in terms of actually getting into the business. But first realizing that okay, what I was doing was not the right path, and then saying okay, um, it's just time to figure something else out.
That's cool that you did that. I love that you moved to where you wanted to be and was searching for a job. It's very old school.
Yeah,
Um,
yeah, and it was, yeah. I mean, in hindsight, some of this is like even to me today seems a little crazy. This was 2002, so you can imagine that's still in that recession coming out of the tech bubble, and these are things you don't realize when you're young and you have no appreciation of market cycles or history or anything of that nature. But maybe that was for the best.
yeah, that was the beginning of a great run for value.
That's
One
right.
that one that one
That's
that
right.
hopefully repeats. Now, I'm curious, what
Absolutely.
bothered you about the repetitious nature of surgery? So interestingly enough, the other investor I know who used to be a doctor, he was an orthopedic surgeon,
Hmm.
Ken Schubenstein. He's the guy who got me into the investment business. He gave me my start.
Hmm.
He gave me a book, I don't know, 5 years ago by a surgeon, and the guy was talking about high performance, peak performance. And he'd talk about how before his surgery, he'd show up and he'd practice the surgery. He'd literally go through the motions. And I was awed by the guy's dedication, but I thought I could never do that. Something in my soul would scream at the thought of that kind of repetition. I can't stand it. I'm curious if you're the same way.
I mean, yeah, I mean, it's something that I came to realize as I was immersed in it.
Yeah, I
You
bet.
know, again, neurosurgery. I mean, it's an amazing profession, and many of I have many friends who are neurosurgeons, as you can imagine, given my background. But even in a simple, quote unquote, simple cranial procedure, head procedure, I mean, there's a very little of it that's the really intense part, right? A lot of it is closing and opening and suturing and that sort of thing. So yeah, I mean that technical repetition is a lot of what you do, and it's not like the made for TV, where you're doing open cardiac massage and that sort of thing. I mean that's not that's not the bread and butter. I mean I remember I did a month of cardiac surgery as a general surgery intern, and it's pretty intense when they're taking someone off the heart lung machine or putting someone on. But in between, in terms of like sewing the coronary arteries together, I mean that is a fine, very fine, very delicate, repetitive process. I think someone compares it to kind of sewing a bubble, if you will. And but it is what it is. I mean, you have to be extremely, extremely take a lot of pride in that step by step repetitive process. And but obviously there's people who are fantastic at it. So yeah, you get exposed to it both in various disciplines within surgery. But yeah, no,
And,
for me it was, unfortunately I didn't have the foresight. I figured it out as I went.
and I'm curious. So once you got into investing, you're starting with a hedge fund in 2002. Did then you're exposed, you're immersed, you're working in it, and I assume did some sort of school of thought when it came to investing immediately take hold in you, or did you read about value investing and that immediately seemed interesting, or compounders, or growth, or was there something that we were sort of like, this immediately makes sense to me?
Well, I would say again it was a gradual process, but somewhat I do remember at the first hedge fund I was at. I was only there for a year, but I really enjoyed at looking at situations where a stock or sector was out of favor. I forget the exact details, but I remember looking at this generic pharmaceutical company. I think it was called Bar Pharmaceuticals, which was later acquired by Teva, I think, and it was down 30 or 40% from its all-time high. And something about that immediately was something I got interested in. I really liked the idea of rolling my sleeves up and looking at something that was out of favor. Is that traditional value investing? Well, I forget what in that case, I suspect it was a value situation, probably a high single digit, low double digit PE multiple or something. But in general, I would say fairly early on in the investment career, there was something about looking at things that were out of favor for whatever reason that took hold.
Yeah, that's interesting. I started investing a little bit of my own money in 2000, and I remember I would just buy stuff with the lowest PE. I was just
Right,
like, what
right,
is the most beaten down, hated thing? And
right.
I just reflexively wanted to buy that. That just seemed interesting to me, knowing nothing about them. And that kind of turned out to be my error in a lot of ways. It's something I still carry with me a little bit. But and it's funny how that is. It's kind of, I found I'm curious if you found this too, where the things that initially worked for me and didn't work for me are still the same things I deal with today. Like I feel like investors are generally either payoff investors or probability investors. Either they want to invest in stuff where there's a big upside and that really excites them, or they're people who they're not as excited about that. They just don't want to lose money. They want to invest in high probability, low stress things and just let that work. And for me, I'm a payoff hound. I just love that. That just something comes alive in me. And I'm curious for you. Do you fit into that continuum in some way?
Well, I've always been a bit risk averse. And for example, I spent the first half of my investment career in healthcare, as and for obvious reasons, given my background, and that actually lasted through my early years at BlackRock, and then it's only after that that I evolved into a generalist. But in healthcare, as you can imagine, biotechnology is an area of where you have that potential tremendous payoff.
Mm.
Um, it's an area that I dabbled in, especially in my hedge fund days. It's almost you almost had to, right? If you're a healthcare specific investor, especially in the hedge fund environment, you almost had to dabble in those binary situations, phase two, phase one, even phase three outcomes. And I
And that
found
stuff even scares me. That's just I would never venture there. That's just unthinkable to me. That's a
so
tough
maybe
area.
that may not be a good example of kind of what you're talking about from a payoff perspective. Um, but
No, no, no. That's a
but
perfect
yes,
example. Go ahead. That sounds interesting.
yeah, but yeah. So I found out pretty early. I mean, relatively early on that sort of like those sort of payoffs, like I just couldn't assess probabilities.
Mm.
So again, I know that's not what you talk about in your paper, which I read several times, but yeah. So I guess when you want to look at stuff that's out of favor, you're somehow tilting to theoretically tilting the probabilities in your favor that if your fundamental assessment's right, the odds are somehow stacked in your favor that you'll have a reasonable um, uh, payoff. Um, yeah, so but to your point on being a bit biased towards one way or the other. I like looking at cheap stuff. Um, and sometimes I have to stop myself from getting too excited when you just look at top line valuations and whatnot as a screening tool. Um, but yeah, so I like the idea of payoffs. I think as time has gone on, you realize that the number of times you get such opportunities for payoffs is it's relatively uncommon.
Mm.
Maybe once every couple of years, where everything comes together, either at the stock specific level or even more uncommonly, a larger sector, related observation that you can capitalize on within an area that you understand. Um, so, yeah, I mean, I think all these things pay like these concepts are great. Just understanding that in reality, you may not come across them that often.
Oh yeah. It's there hasn't been a lot that's offered that what I would consider to be high percentage and high payoffs in a while. It's been tough sledding for 5 years. But I noticed looking at your holdings, you hold a lot of high quality stuff. These are good. These are good businesses.
Yeah,
Other than Allison Transmission, where it's where obviously over the very very long term there's obsolescence risk, but with the other ones that's not the case. But they're all high
yeah,
margin, high EBITDA margin businesses. That's what struck me.
yeah. And I think that's for me, that's been a bit of an evolution, from that focus on absolute cheapness to
Mm-hmm.
perhaps more of a combination of you want to get a good deal on something you're going to buy, but you may not get like a great steal like 5 6 PE type of purchase opportunity opportunity to purchase an asset. So I guess that for me it's been a gradual evolution. And a lot of that's occurred over the last 5 years since I left the more traditional asset management environment, where I'm playing a much more concentrated game. And when you start thinking about, and perhaps we'll discuss this later, so I might be jumping the gun, but once you start thinking about operating a more concentrated portfolio, whatever that means, 5 securities or 25 securities, let's call it somewhere in that range, versus the playing the traditional, you know, um, hedge fund or mutual fund, type of game where, it's a very diverse or very high turnover, uh, strategy, you start thinking differently. You start thinking about opportunity cost. What is my opportunity cost of not owning, position number 11 versus, number 10 or one of the top, the 10 that I do own. And so this kind of, you start thinking like that. I think it naturally forces you a bit towards higher quality, whatever, and again, quality is a very subjective, uh, you know, topic in and of itself. But yeah, I mean, I think you naturally gravitate towards slightly, or even more than slightly higher quality situations, especially when they're on sale. And usually that's when we've picked up, some of these, companies, Copart, Old Dominion Freight, lines, and, et cetera, et cetera. I mean, it's usually when they've been, marked down for some, random reason.
Yeah, that's happened to me as I've gotten older. Really, over the last 10 years, it's just there's something about. I guess I always think about it less in terms of quality, but high percentage versus low percentage. A wood
Hmm.
products company is a low percentage business. It's low margin. That's its nature. Its sort of historical character. There's just a huge variance around it. There's so little predictability there. Stuff like that. A lot of commodities,
Hmm.
auto stuff. Right, right. All of that. It's just
Right.
I find it exhausting a little bit. It's just I don't really enjoy the work on it. I don't find that really smart people will offer predictions on it and it doesn't come true. And I've just found as I've gotten older, I'm just sort of sick of it and not interested in it. And it just seems low percentage and like a waste of time. And I suspect that happens with a lot of people.
Yeah, I mean, it's interesting. I mean, some of these things, that seem cheap or have been out of favor, the question is, whether it's the economic characteristics of the business or for some other, stranger reason, maybe these things don't mean revert, right?
Mm-hmm.
I recently did a study, after reading John Neff's book for the second time on, you know, low PE investing. I did a screen. I recently found that over a third of the S&P 1500 was trading at under 15 times earnings. But within that, there's some areas that always look cheap: airlines, home builders, banks, other financials. I could go on and on. You mentioned autos and auto suppliers. I mean, some of these things always look cheap, and so and then you do the work, and you even get more interested, and so then it's like, okay, why don't these things tend to work over time or mean revert or whatever you want to call it, or why don't you get the payoff? And yeah, I mean, I'm sure there's some intricate, business reason why um, you never really get the payoff on those situations. On the other hand, on the higher quality side, there seem to be more predictable underlying characteristics: high returns on invested capital, high returns on equity. You're shrinking the share count, manager alignment, through stock ownership, et cetera, et cetera. So I would just say one side of the equation feels a bit more um, predictable to me, than that, investing in the statistically cheap stuff. But obviously, as you've even written in your paper, there's people who've made, had tremendous careers investing in the statistically cheap stuff too. So I guess it's kind of what you feel comfortable with, and what you can sustainably generate returns with in terms of strategy.
Something I really enjoyed in your investor presentation was you showed how few firms run concentrated portfolios. I was actually shocked by the numbers that you found, how few there are out there. It's something. It's I don't know what it is in percentage terms, but it's tiny firms that hold less than 20 positions or even less than 35 positions.
Yeah, I mean, it's actually it's interesting. It's an exercise I went through, when I was in the process of leaving BlackRock, and thinking about the strategy. I just wanted to see, I wanted to frankly network with other people out there, that employed this more concentrated way of investing. Again, broad terms, let's call it 30 securities or less, right? Five to 25, five, in that general
Hmm.
range. And to your point, there are some, but not many, and especially people that I could find just by looking at filings on Bloomberg and whatnot. So these might perhaps the numbers a bit larger in terms of smaller managers who don't file with the SEC yet. Um, but yeah, in general, I don't think it's a way of operating um, that um, resonates, number one, but also it's very difficult, I think, to consistently do, right? Because by definition, when you're
Mhm.
concentrated, again, whatever the figure is, five securities or 25, there are going to be periods of times where you do very well. And there's going to be periods of times where there's sustained underperformance. And both periods are extremely dangerous. I just recently read a book by Paul Marshall, the founder of the big hedge fund, Marshall Wace. I think he just published it this year. It's called 10 and a half Lessons from Experience. And, he talks a lot about a lot of different things, but he does talk about concentration and how that, in their experience, they found that, the vast majority of portfolio managers create the most value in their top 10 ideas. Um, but he kind of, his last chapter also discusses how most careers in fund management end in failure. And the and he kind of the next several pages are extremely very they're excellent. But he kind of talks about how when you're doing really well, it's just it's natural as a human being to have some element of hubris creep into your psychology. And when you're not doing well, it's the exact opposite. You're not sure if you're going to be in business the next day, either psychologically or because clients pull money. And so I think if number one, concentration is just not psychologically a comfortable way for most people to operate. Number one, but number two, if you do operate that way, um, you're almost decreasing the probabilities of long-term success if you're trying to build a business or whatnot, because of what kind of going back to what Paul Marshall said in his book. So there's a couple of aspects there where when I consider those things, I say, okay, it makes sense that there aren't that many people, especially in the managing in the billions of dollars that operate this way. But there are some, for sure.
Mhm. Yeah, that is interesting. It's true. It it increases your long term success in terms of the returns, but it pumps up the variance,
Absolutely,
which basically means you're more likely to hit an absorbing barrier that ends your career. It ups the path dependency.
absolutely.
That's very interesting. It's a very funny business because the randomness around it is just
Hmm.
insane. When someone starts their fund, excuse me, matters so much. You look at someone who starts in 2000. There are so many people who are famous today who started their funds in 2000 or
Hmm.
2001. I don't think that's an
That's
accident.
interesting.
There's something about it where I think people who, or maybe they're just people who weren't starting value funds in 1998 or 1996, but there just aren't that many. It's very interesting to me though, but the concentration it's funny. We've looked at the most successful investors in history, those who have at least 2.5% alpha over 20 plus year periods. And almost all of them run concentrated portfolios or something that is quite a bit more concentrated than the average fund manager. And the other thing I think is interesting is there's a lot talked about today about how investors have all these emotional cognitive issues and that those lead to errors. I also think a lot of it is just the math in investing is complex.
Hmm.
And I don't think people understand, just sort of stop and think about a lot of the mathematical implications of what they're doing. For example, if you have a wealth advisor, they'll probably have you be in 6 to 10 mutual
Hmm.
funds,
Hmm.
and each of those mutual funds own 100
Right.
stocks.
Right.
So at that point, you basically own a third of the
Right.
market. So what are you paying a fee on that for? It's basically mathematically impossible for you to outperform. And so, but people don't get that. And I remember seeing Charlie Munger speak, and he made an interesting point. He was saying, I don't really farm out my investing to other people. I do it with Lee Lu, but not
Right.
other people, because if you look at the fees, people don't think about this mathematically. If you look at the fees that you pay to a hedge fund or even a mutual fund, the mutual fund gives you more tepid outperformance and they charge a lower fee, and the hedge fund, even if it works, they're going to take a third of the upside. So it's just, when you look at that, you're losing 40% of your upside. He said 60%. I don't think that's right. I think it's more like
Mm.
40%. But this stuff is just, it's very hard to figure out. I'm always struck by that. There's just these probabilities and these numbers out there that, unless you really do a lot of work to think about it, it's kind of like poker, where unless you've thought about this in a deep way, you just don't even see that level of it.
Yeah, no, absolutely. And to even pile on top of that, if you think about from a tax efficiency standpoint, if you're the average investor investing in an index fund, month in, month out, for 30 years, you put, in a disciplined way, whatever you can into an index fund. That's very tax efficient. There is some turnover because when the S&P 500, has constituents coming in and out, there is some, tax turnover, there is some turnover, but, the taxes that you pay are minimal in achieving, and obviously the expenses that you pay are minimal in most index funds, if not all in, plain vanilla index funds. So if you look at it from that standpoint, when I was in the institutional world, whether it's in the hedge fund side or mutual fund side, no one talks about after tax returns. So even if you beat your benchmark, again,
Mm-hmm.
you beat that, let's say in a good year, a mutual fund beats the S&P by 3 percentage points. On an after tax basis, if you're a taxable investor, I suspect that figure is a lot lower. And that's definitely not discussed. I've been in that environment, and all people look at are pre-tax, pre-tax after fee returns. The after fee, at least they're looking at after fee returns. But from, one of the things, when you start managing your own money along other people's money, you start thinking about, I think it's, interests are really aligned. And you start thinking about things like this.
Yeah, yeah, it's interesting. By the way, I'm curious, how did you come across John Neff? Because I feel like nobody knows about John Neff. I love John Neff. I haven't read his book, but I've read almost every interview he's given, which is not that many. I think he's a really cool guy, and I always liked his that he thought about things from an absolute value, absolute return way. He had some, I can't remember what it is, but he had this formula where basically he'd add the dividend yield to the growth rate. And he was one of the first people I came across that from, where basically a lot of people today do free cash flow yield plus the growth rate. But he was just sort of like, I'm going to use the dividend yield and do that. And he'd be looking for stuff where when you added those two numbers together, you'd get 15, 20% sometimes. And that's a high absolute return.
Right, right.
But I'm curious how you came across him.
I've always respected Wellington. What happened is there was a recent biography of John Bogle, a new biography of Jack Bogle. I actually had the opportunity to meet Jack back in 2011. Vanguard's not too far away from where I am in Princeton. They're in the suburb of Philadelphia. Anyways, there was a
What was that like?
Oh,
Wait, I got to hear what was
he's
Jack Bogle like?
unbelievable, like amazing. Sat down with me for whatever it was, hour plus, gave me all his attention, answered all my questions. Obviously, we know his inclination, towards passive investing, and he
Right.
knew that I was a traditional, mutual fund guy, with BlackRock at the time, but very cordial, very nice. Signed my book, press, with his typical, press on regardless. If you remember, that's always the quote that he'd always tell people. But yeah, no, I mean,
Oh, I love
yeah,
that. So that's his quote, press on
yeah, press
regardless.
on
That's
regardless.
good.
He's like, I think used that since like, the old, when he was like first starting out. But amazing. Anyways, but yeah, amazing personality, amazing person, genuine, down to earth, but would give even a guy like me, the time of day. I mean, it was just amazing. And he was surrounded by all these academic papers he was writing. I mean, at this point, he was well into his 80s, maybe mid 80s. There was no reason for him to continue, but he just loved the game. You could tell, and would be writing papers constantly, doing interviews, occasionally, that sort of thing. So, very engaged. So I was reading a recent biography about Bogle, and then you learn about in that biography about the whole history of Vanguard and Wellington, how they were together, then they split up, and now they have a very intertwined relationship. So that kind of rekindled the interest in learning a little bit more about the Wellington side of Vanguard, because we all know a lot about Vanguard because there's been a lot written. They're the largest asset manager, or second largest, I guess, after BlackRock, but probably the fastest growing. And so that kind of I thought about, okay, I read about John Neff once a couple of years ago. I read his book, and so I just went back and reread it. I mean, what fascinates me about all these great, quote unquote, great investors is, like, unlike when I was in surgery. Okay, when I was a doctor, when I was a surgery guy. If you went back and read someone who played the game 30 years ago, right, it may or may not be relevant because the surgical techniques change, the way that like, there's minimally invasive surgery that's available now that might be the standard that wasn't the case way back then. In investing, all the lessons, like, have been learned. Like, there's nothing really new, right?
Yeah.
Like all the behavioral and psychological, like all these lessons have already been, like, experienced by every, like, and now you have a guy like John Neff who was a fund manager at the highest level for 35 years. I mean, like, that's just, like, unbelievable amount of, like, wisdom, like, in those 200 or 300 pages. And there's so many examples like that, right? Like, whether it's Peter Lynch or John Neff. Another favorite is Merrill Rukeyser, who was Louis Rukeyser's father. He wrote this book. I forget the name of it, in the 1930s, or and it's the same lessons that investors learn today that were pertinent 100 years ago. So that's what amazes
Wait,
me
wait, that's really cool.
about it.
Wait, have you read the book
Yeah,
recently, or
yeah.
you read it a while ago?
Which one? The Merrill Rukeyser
And
book?
yeah,
Yeah,
is he a value investor, or
yeah.
is he a trader,
No,
or
no.
what is it?
Merrill Rukeyser was he was like you and me. He would manage portfolios for himself, but also several other people. We call them separately managed accounts now. Um, and Yeah, I have the book at home. I reread it maybe 6 months ago. Um, but it's just, you read these books from 50, 100 years ago, 30 years ago, 20 years ago. Like, it's all like, and certain people emphasize certain lessons. So maybe John Neff might emphasize the low valuation way of investing. Peter Lynch, more of that kind of, like, anyone can invest based on experience and going to the mall and seeing what's hot and all that sort of stuff. So, like, everyone has a slightly different angle, but the behavioral
Hmm.
lessons, the underlying, like, calculation of intrinsic value might differ, but the general concept of having to have some sense of what the value of some underlying asset is, like, that's just repeated over and over again, right? And it all just depends on which one or two people, like, say it in terms that really resonate with you. I just like reading everyone.
That's really interesting. I never really put it together until you just said that, but I think I've never been able to square my interest in investing with my interest in writing. And I guess I'd never thought about it quite like this until you just said that. But I think what's so fun about both is they connect you with the past, where the past is not a dead thing. There are answers there in the past, and there's wisdom there. And when you read these books, it really connects you with these people's lives. My favorite investment book is The Great Depression: A Diary by Ben Roth,
Huh.
who was just investing his own money. He was an attorney in Ohio, and it's just he talks about all these bargains he was looking for and stuff he comes across, and then his own struggles with money. But you see a man's life in this diary that's ostensibly about the market. You see his frustrations
Hmm.
and what they're going through, and in part why we're all doing this is we want some level of financial freedom.
Right.
That just there's a great quote by Naval, where he's basically saying if you have a certain type of mind, you really need to become independently wealthy, or the system will crush you down. And I've always felt like that about myself, and I think a lot of people who invest feel like that. They're differently temperamented from everyone else, and they want out. They want an opt out. But
Yeah,
return.
the concept of temperament is fascinating, unfortunately, it's something that either you have or you don't. It's very difficult to teach. So again, yeah, just an observation. Go ahead. Sorry.
Oh yeah, no, it's totally true. I met a guy who was looking to hire someone. He runs a value fund down in North Carolina, and he's kind of like you. He owns the Sprouts farm markets,
Yep.
SFM,
Yep. Yep.
ticker SFM.
Hmm.
But some I think that's the only overlap. But he likes high quality stuff and reasonably priced. He was telling me that he couldn't find anybody, and the issue wasn't that they weren't smart or hardworking. It was just that in their heart of hearts they weren't value people, and
Yeah,
he couldn't bet on that.
it's very.
If
I
a person
mean,
lacks it.
yeah, and yeah, I mean, it's if you find someone with experience, they're somewhat stuck in their own ways, for better or worse.
Yeah.
And then if you find someone with a lack of experience, it's very difficult to judge whether a certain investment philosophy will take, if you will. Um, so, uh, so, yeah, I mean, sometimes when it comes to, I've had a couple of interns work with me in the summer, um, and it's interesting. It's only after you start working with someone that you're going to figure out pretty quickly whether your way of operating and or investing and resonates with someone or not. But yeah, there's not. It's very difficult to. You can teach, but you can't really um, force someone to adapt your way of operating. It's just very difficult. It's one of the things
Yeah.
that's very difficult about this profession. There's a lot of great fund managers who have a very tough time passing on their business to the next generation. And I think even if it's a family member, the next generation you want to pass, that's worked with you, they might be of a totally different temperament, right? And so it's interesting. I mean, it's unfortunate, but it's very difficult to pass on the skill set in our business,
It's oddly a very personal thing.
right?
It doesn't seem to be. On the surface it's about making money, but there's something deeper there. And the people who are successful at it, it's not just about making money to them. They're really expressing a lot of themselves in it. I
Absolutely.
think, and that's something that's really, I think that's why a lot of people fail, is that they're just not interested in it enough to put themselves in it. And so the people who do well, it's not just about making money. It's not just about being right. That there's something where there's meaning in it for them.
Absolutely. Yeah, and that's why we see a lot of people, whether it's sell side or buy side colleagues, that transition to other, you know, um, they might do this for a few years or 5 years, and then they transition to the corporate side of, the finance world or whatnot. Uh, but yeah, I mean, the number of people who just do this for 30 years, I would say those numbers are low, and we actually, we read about them in the books.
Yeah, it's interesting. Well, we created a database of what we would consider to be the greatest investors in history,
Hmm.
who have the 2.5% alpha over 20 plus years. I could only find 85
Hmm.
people where I was reasonably certain that they'd achieve the results that had been claimed. There's probably at least several hundred, I suspect. You just don't know about these people, but that's not very many.
Yeah, no, I mean it's going back to Paul Marshall's quote. Most careers in fund management end in failure. It's a very
Yeah,
sobering thought, but it's very empirically true as well.
well, did he have any other advice for us? How do we avoid that? Did he have anything to bring us back from the cliff?
I mean,
I'm all ears.
I mean, it's basically what we discuss. It's like it's during those periods of failure or success, right, that are basically going to determine whether we survive, right? And success. I mean, you start maybe in periods of success, you take outsized risks. You veer away. And this has happened to me. I remember, when I was at BlackRock, I did really well from 2010 to 2015. Healthcare was a hot sector. I mean, you almost couldn't make a mistake as long as you were buying healthcare. And this is if you remember, like healthcare was out of favor in 2010 because of the fear of the Affordable Care Act from Obama and the impact it would have on the healthcare system. And so the whole sector was out of favor, and you could buy anything for the next, hold it for the next 5 years that did well. And then, you slightly lose your discipline, you start doing some IPOs, and then like your performance, turns over. And on the other hand, after a period of underperformance, it's very like easy to give up, right? Like, oh, let me go work for someone else, or let me leave the profession and go to industry, or the corporate side of things. And yeah, so I don't know, it's something about the mental resilience when you're down, and something about like reining in the hubris when you're really doing well. And long as like that's what he talks about. And it's only like five or six pages in the last chapter of the book that's makes the whole thing worth it. I mean, there's a bunch of other lessons, and he explains concentration in slightly different terms than you and I are discussing. Because like he runs a hedge fund, and so they have these 40 or 50 stock portfolios for the individual portfolio managers, but the vast majority of what they call, I forget what kind of risk, is in the top 10. So it gets a little wonky.
Mm.
But like that last chapter completely, like I emailed him after I read that, and he was kind enough to email back, and that really blew me away. I read, like that was like I read a lot of books every year and a lot of other things, as many of us do. And that was like those 5 pages were the most consequential of my readings for this year, most influential, I should say.
Oh, that's cool. I got to check that book out. It is funny though. You were talking about how people exit close down their shops after a few years of underperformance. I've actually, we haven't kept up with the market over the last 5 years. We've mildly underperformed and been very excited about that because we're a value shop.
Mm-hmm.
But it's interesting. I've had people, people in my life who said, "Look, you've underperformed. You've failed. It's over." And I'm just sort of like, what? I would have never started if I had that attitude. I don't remotely feel like that. But it's interesting how people are. It's very hard to judge things by the results, even over the medium term in
Right.
investing. If you were a value person and you shut down your your firm in 1999, you missed out on 13 years, some of the 13 best years in the last 100 years for value. It's very interesting. You have to have something beyond just this sort of accountant's mind of just looking for numbers. You really have to have some faith. I love that. I love that about the business.
Yeah, I mean, and these cycles, whatever cycle we're talking about, goes on. Often they go on longer than you think. I remember in April of 2021, we have this small investment club locally here in Princeton that we communicate with, through various chat groups. And I remember like one day I read the Wall Street Journal and the Financial Times. I was like, this is really crazy how frothy things are in the private markets, and the unicorns, and what kind of valuations companies were getting. Obviously that last and things were really crazy in April of 2021. Obviously that lasted
Mm-hmm.
another 6 7 months. Now that's just 6 or 7 months. I mean, this value cycle that you're referring to, obviously, I mean, if you just look at the Russell growth over the Russell value, um, in some ways the craziness has exceeded um, what you saw in the late 90s.
Mm-hmm.
And this only started inflecting downward. Of course, when you use these broad terms, growth versus value, you immediately have to define them, and that becomes somewhat difficult, right? Like, is Google growth or value? Is Facebook growth or value now? Given how much the valuation has declined, and so
Mm-hmm.
I think it's difficult. Um, but I would say like reasonably priced. Let's just say reasonably priced assets right now in the stock market, U.S. stock market, seem pretty plentiful. So
Hmm.
I don't know where exactly we are in this growth value cycle. I think, reasonably, like current cash flows are definitely more reasonably valued today than they were a year ago, um, relative to growth. But all I can say for sure is that there's a plentiful number of investment opportunities, and it definitely feels like a friendlier environment than a year ago. Um, but sorry, I kind of veered off a little bit in terms of your
No,
question.
a year ago, it was absolutely crazy. I'm curious what you think about this because when I look at, I don't do a lot of macro stuff. I just don't want to get involved in that, but I don't want to completely ignore it either.
Right.
But when I look at a lot of things, and I really try to be very much absolute value focused. If there were no markets and you just own the asset, what would you make from it every year? And markets
Hmm.
generally return 8 to 10% a year. So if you make that, then that should be valued at 16 PE, what the long term market average, something like that. And if you could make 20% a year, then you deserve a premium multiple on that. But just looking at things in an absolute value way, when I look at individual securities and ignoring the Schiller PE and
Hmm.
all the and Tobin's Q and all these broad valuation metrics, here's what I see. I see companies with far richer margins than historically they have. Far richer margins. It's not just for a year or two, for several years,
Hmm.
and then they're trading at basically a valuation where it's very hard to see how they even make that long-term market average return of 8 to 10% a year. It seems more like they're priced to return 5 or 6% a year. And so
Hmm.
when you add those two factors together, it makes me nervous about a lot of things. And only
Hmm.
recently have there been more reasonably priced things. And I still am not finding a lot of really cheap things out there. We've had to go internationally. Most of what we own is stuff that's not in the U.S., which I don't like. I'd rather have most of the money here. But I'm curious what how you have handled all that.
Um, yeah, I okay. So, couple things. I just like you. I pay a lot of attention to macro. I read several newspapers every morning, um, and so I enjoy, frankly, paying attention to everything that's going on out there. And to be frank, some things are 100% directly relevant to what we do, right? Like interest rates. Like there's no doubt
Hmm.
that like interest rates matter.
Yeah.
Now, are they predictable? And what's the exact right PE ratio for the S&P relative to where the 10 years today? Like that, I don't have an opinion on. Um, and I purposefully only focus on the U.S. Like I like to have a finite investment universe. It's one of my learnings from previous experiences. Like I like having a bit more of a finite investment universe versus if you're an international investor, it's great. You always find something or an area to look at. Um, but I like the like just focus on the U.S. and also the accounting and everything. It's much more familiar to me. Um, yeah, and then in terms of like your broader point on like I like that you just don't find a lot of cheap stuff out there right now. Um, yeah, I guess I would take like I'm not sure that this definitely is not '09, but is this 2011? Where like in 2011, if you remember, that European debt crisis felt intractable, right? Like it felt like there was no way out. And people, and I say people meaning most investors, um, the average investor was focusing on the macro and not finding stock specific opportunities. Um, I kind of feel like it's analogous to what we're experiencing right now, where like inflation feels intractable. Like that's all that people can think of, and it's in the headlines every day, and in interest rates going up, and just like back then, the average investor lost focus on what matters, which is finding, a few good securities to invest in. I feel like it's a very analogous situation. So when I wrote this recent memo after reading John Nutt's book that I alluded to earlier about over a third of the S&P 1500 is valued at under 15 times earnings. So there has to be something out there of interest. Now, whether you find a lot or not, like that's a like I don't know how to but you don't have to find a lot, right? Like you and I are relatively concentrated, so you may just have to find one. Like if you found one new thing to invest in or two, I think I did three this year, which is somewhat unusual. Um, like that's plenty, right? So that's kind of how I think about it. Like I really enjoy paying attention to macro, but in terms of what you and I can, as concentrated equity investors care about, like it's fine. I mean, like if we find one or two things in a year like this, that's like a huge home run. And if we don't, that's also fine. Like, if you miss something, if you remember, like Buffett, he didn't buy anything in 2020. He didn't buy anything, and he even talked about it. It's okay. Sometimes, you get an opportunity, you just don't seize it. So that's fine as well.
So I'm curious how you guys are responding to the macro environment.
Um, I I found a few new investments this year, which is a bit more than usual. Just looking at kind of what we own. Um, Markel Corporation, which is an insurance company. I think they had a higher combined ratio earlier this year. So that was, and the stock was down 20-30%. So that was an opportunity, with the concern around a potential recession. We added Old Dominion, which was down 40% from its all-time high, company that I studied recently. You had mentioned Sprouts Farmers Market, again, a relatively recent addition. So, and then we have some couple other smaller ads this year. So I would say we've been more active this year, a lot more active this year than last year, and primarily um, it's because we added a few new positions, and were they dirt cheap valuations? Probably not, um, but
Mm-hmm.
sometimes when something is off, what gets me interested is when you have a really interesting asset that you at some point you might want to own that's off 30, 40, 50% from its all-time high. Even if it's not like at a discount to the S&P, it's fine, as long as it's still not trading at 60 or 70 or 50 times earnings, um, which is
Mm-hmm.
frankly, I think a lot of that has been eliminated from the market over the last 12 months. So I think like a high quality asset that a year ago would have been 60 times earnings, now it's probably in the high 20s, let's call it. Is that the right valuation for a US 10-year at 4.5 instead of 50 basis points? It seems like it's okay. Could it get cheaper? Sure. Could those assets get cheaper and lose another several multiple points? It's possible. But I would say in the 4.5 years I've been in business running RBL, this has been the most exciting, the last 6, 9 months have probably been the most exciting period in terms of, looking at new investment opportunities. Of course, things can get cheaper. If a recession does materialize, I'm sure some of these cyclically oriented companies will won't do well. I think we're already seeing some fear
Mm-hmm.
around that. Obviously, in the last couple of weeks, as you look at like the bank sector and some other cyclicals, they seem to be indicating that the market fears that some type of recessionary scenario could play out. Um, so yeah, I mean, so I tend to be, like in general, I tend to lean a bit, on the positive side, and that's definitely the case more so in the last after the last 12 months or so.
Do you have in your head kind of an ideal investment? Is there something in your head that's realistically an ideal investment for you, and it's just your 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 sweet spot?
I mean, so something that okay, so the basic criteria is like I don't specialize in unprofitable companies. So for me, something has to have a
Mm-hmm.
certain free cash flow threshold. Let's call it 50 to 100 million a year on a history of it. So I'm looking at for companies with a certain track record of generating cash flows. let's call it ROICs, ROEs in that 15 to 25% range. Um, a management team that is well aligned with me as a potential shareholder through insider ownership that isn't a token ownership, but has a significant part of their net worth in this in the company. And then from a growth perspective, ideally it's a company that has maybe relatively low share in a growing business. Um, and so fundamentally, you can pencil out a 5 to 10 year growth runway, from a market share and a market growth perspective with favorable economic characteristics, with a management team that's aligned, and perhaps capital allocation policies that make sense. I would say that's right at the top of the list. So I'm a big believer that a lot of the stuff that you need, a lot of the information you need to make investment decisions is available in the public domain, number one. But in order to judge a management team, you can just judge you can just study their history as opposed to what they're telling you,
Mm-hmm.
they'll do right now. Um, and so it's kind of like it's a combination of things. And hopefully within reason, a smaller market cap, the better. Um, so I recently visited this insurance company, 6.7, let's call it 7 billion market cap. They play in a subsegment of the PNC insurance industry that's growing above the PNC industry. They have 1.5% market share. They're the low cost operator, very good history of combined ratios. The management team owns a huge stake in the company. Uh, they think and operate like owners. Um, and so like that's an example where I'm really interested, kind of like all the cards line up. It's been around in the public markets for call it 13 years or something.
Mm-hmm.
So it's kind of a combination of those things. I mean, hopefully something that and then the last thing would be, something that's not egregiously valued. In this case, this company happens to be valued at 30 times next year's earnings. So that's the one knock against, the insurance company I'm referring to. But I would say,
Mm-hmm.
yeah, I mean, but it checks all the other boxes. So, like that's a good example. If you look at like our portfolio, going back to the point on capital allocation, most of the companies have a history of shrinking their share count with excess, cash flows, um, and that's something I like to see as well. So yeah,
Mm-hmm.
it's a combination of things, but when you put everything together, the list starts narrowing pretty quickly in terms of what you would own over a long period of time. Um, Occasionally, I will play a larger um, observation. You call it. I know in your paper the concept of sameness. I call it mean reversion.
Mm-hmm.
Mean reversion. So right now, for example, I think if you look at profitable biotechnology companies, profitable biopharmaceutical companies in the mid cap space, I think they're a prime candidate for that concept of mean reversion or sameness to occur. So we have a few investments in that area. So it's a combination of, as I think about like the way you framed it in your paper about payoffs versus sameness versus value. I mean, that's kind of how I
Mm-hmm.
think about things as well, right? Like it's hopefully in one of those first two buckets, payoffs or sameness, i.e., mean reversion, with some value as well, so that even if you're right on everything, you're not paying too high of a price at entry.
Yeah, that's interesting. I noticed you seem to own a lot of stuff where the free cash flow yield on it is 8 to 10% or so. That seems to kind of be your starting point for a lot of things in the portfolio. Is that accurate?
I would say 8 to 10 is probably a little high
Okay.
on the going because, Frank, I mean, there are some situations where that's the case. A couple of the healthcare facility companies we own, Universal Health Services and DaVita, they probably have those types of free cash flow yields. Maybe a couple others, but I would say our weighted average price to earnings ratio on the portfolio on my estimated 2023 earnings is about 12 times. So, that probably is a good proxy. And I would say the free cash flow multiple, might be just a bit below that, a bit higher than that. Um,
Hmm.
yeah. So yeah, I mean, that's yeah. And there's stuff out there, that we see being able to hold over a multi-year time period, that fulfills that criteria.
I just wanted to end with this. We were discussing earlier reading about investing in history, and I meant to, I sort of drifted off into something else, but I meant to ask you about this. What is it you like about that, where you're reading all these books that are kind of esoteric books? John Neff is esoteric, unfortunately. But I'm curious, what is it that draws you to that, where you're spending time reading about investing in the past? What do you like about spending time with dead people and
Yeah, I
and,
mean,
and historical stuff?
I just think they have so much to teach us, right? In 200 or 300 pages. I mean, you really get, and often they're autobiographies, sometimes they're biographies, but they're very well written. Sometimes they're business figures, sometimes they're investment figures. Um, I do read a little bit outside of those two areas as well. I've enjoyed reading some stuff, stuff about Abraham Lincoln and other historical figures. I mean, it's just like Charlie Munger says, like there's nothing better than learning from the eminently dead, right? So, I mean, like whether it's the human experience, whether it's how we react in periods of victory or defeat, it's how these people dealt with personal tragedy, how they dealt with tremendous success, um, uh, professional life, personal lives. I mean, like it never ceases to fascinate me. Um,
Mhm.
Obviously, as a capitalist, I enjoy reading about the success stories. I just read this fantastic book called A Banker's Journey" about Edmund Safra, who was the patriarch essentially of the Safra family fortune. Um, and just an amazing story. You and I would think about banking as a relatively boring, very simple business. And the way in which Edmund Safra created this international banking empire over a period of like decades, and how he emphasized, who he would lend to, who he would not lend to. I mean, there's so many parallels. Like I own a bank in the portfolio, so I'm very interested in understanding how a world class banker operated. So there's so many things. I would say, selfishly speaking, 80 or 90% of what I read is somewhat tangential to kind of like thinking about investing or business in some shape, way, or form. So I think it just constantly increases the knowledge base, um, uh, which I enjoy. But just like all the experiences are there. Like it's everything that you and I experience as investors, as human beings. Like someone else has experienced in the past. So let's like like maybe we can become just a little bit wiser by reading about them, and it's all out there, right? Like I mean, at my fingertips, I could walk around my office on a 2 mile loop and have 100 books on my Kindle and walk and read. I remember reading some amazing biography, new biography of John Maynard Keynes, during COVID, just walking around like for miles and miles and just reading this like 500-page biography on my Kindle, and it's just like it's all there at our fingertips, right? And so why not do it?
Yeah, I feel the exact same way. And I'm struck by, if you read Marcus Aurelius writing 2,000 years ago, or someone, Tolstoy writing 150 years ago. I'm just struck by how much life doesn't change.
Right.
The stuff changes, but we don't really seem to. And even when I'm reading about an investor in the 1930s, it's fascinating how similar it all is. And you read
Absolutely.
about people gambling in the 30s, and then that was outlawed for a long time, and now it's back.
Right.
None of it seems to change.
Right.
Just they're just different fashions. But I love. There's something wonderful about that. I'm not sure I'd want that. That's very frustrating, obviously, there are a lot of people who put a lot of faith in social progress and things like that, or other types of progress, technological progress. But sameness suggests that those things aren't going to deliver us to some different state of being. But it's I kind of like the sameness. I love that we have that connection.
Absolutely.
So,
Absolutely.
well, listen, I wanted to thank you for coming on. This was great. I'm glad we made the time to do it.
No, thanks so much for having me, Scott. Really enjoyed it.
Hopefully we can do this again sometime.